Let's talk about the valuation process. Valuation is simply the process that links risk and return to determine the price or value of an asset. And we have three key inputs in the valuation process. First of all, the cash flows. So for bonds, the cash flows were the coupon interest payments as well as the promised principal repayment at maturity, the par value. The timing of the cash flows, when do the cash flows occur? So again, for bonds we had annual coupon paying bonds as well as semi-annual coupon paying bonds and even zero coupon paying bonds. So the timing is important. We also need a measure of risk. In other words, what is our required return? So for bonds, we could look at the yield to maturity of similar bonds in the market to determine a required rate of return. And for stocks, we will also need to determine a required rate of return. So just like bonds, we use a basic valuation model for stocks. So the value of any asset, whether it's stocks, bonds, real estate, is simply the present value of all the future cash flows discounted at a risk appropriate rate. So our cash flows can be coupon interest payments, maturity par value repayments in the case of a bond. For stocks, it could be dividends as well as future stock price. For real estate, it could be the rental income. But in any case, the value of the asset is the present value of the future cash flows discounted at some required rate of return, which there's our required rate of return. And of course, these reflect the timing of the cash flows, when exactly they occur, the first period, second period, and so forth. So to value common stock, it's just the same as bond, is the present value of all future cash flows, except with stocks, instead of having coupon interest payments, we have dividends. And then with dividends, there's always going to be uncertainty as to whether or not those dividends are going to be paid. So when we apply the basic valuation model to stocks, the price of the stock P0 is equal to the present value of all those future dividends. The dividend of period 1, period 2, period 3, and on to infinity. And notice we have the infinity there because unlike a bond that has a fixed maturity date, stocks theoretically do not have a maturity date. So if we didn't sell the stock, the price of the stock would simply be the present value of all those dividends out to infinity. And that gets to be a little bit of a problem, right? Because how do you value something that goes on and on? You can handle this infinite stream of cash flows by using the constant growth model. It's a valuation approach that makes a couple of assumptions. First of all, that dividends are going to grow at a constant rate indefinitely, and that rate is less than the required rate of return. So when we make that assumption, our infinite series of cash flows, and we won't get into it, but it has to do with algebra and Taylor expansion theories, simplifies to the price of the stock is equal to next period's dividend divided by the required return less that G, the long-term constant growth rate in dividends. And we refer to this as the Gordon model. Notice how that P0, the price today, requires the dividend in the next period. If we wanted to know the price in year 5, we would need the dividend in year 6. Now there's an interesting thing about our formula. Notice if we rearrange, do a little bit of algebra here, and note that our expected return on the stock, again, this is the same formula as here, we've just rearranged things algebraically. It says the required rate of return on a stock is equal to its dividend yield, dividend divided by price is dividend yield, plus G, the long-term constant growth rate in dividends. Now if you think about a stock, the dollar return, if we want to measure the dollar return, what's that going to be? That's going to be the dividends that you receive plus the change in an asset's price. And this is going to hold for stocks. If we took out dividends and put coupon payments, it would hold for bonds. If we put in rent instead of dividends, it would hold for real estate. So a dollar return in stock terms is going to be the dividends plus the change in price. And if we wanted to scale that so that we had a percentage return, that would be dividends plus the change in price, and I'll just refer to that as P1 minus P0. This is the change in price. Simply take that and divide that by the initial price, and that would give us the return on investment in a stock. Well, that percentage return then, by the way, this change in price, we call that the capital gain of a stock, or capital loss if the price goes down. So if we to look at that, let's say dividends divided by price plus capital gains. Well, return has to be equal to dividend yield plus this capital gains yield, but we notice from above in our constant growth formula that the return was equal to the dividend yield, which is the dividend in the next period divided by today's price, plus G, the long-term constant growth rate in dividends. Well, comparing these two formulas, we'll notice that both of them say return is equal to dividend yield plus something else. Therefore, that long-term constant growth rate in dividends is equal to the capital gains yield. So for a constant growth rate stock, that long-term growth rate in dividends is simply the capital gains, or in other words, the percentage change in the stock price. So let's apply this to a real company. So we gather financial data on Coca-Cola to get its dividend history, and we can calculate its growth rate in dividends. Coca-Cola appear to be a constant growth rate stock because our formula that we use, the Gordon constant growth model, requires that dividends are growing at a constant rate. So if we have a stock where the dividends are not growing at a constant rate, we could not use the constant growth rate formula. So we pull this financial data from Coca-Cola. By the way, here in the blue, this link, you can click on that in the provided PowerPoint slides, and that will take you directly to the Morningstar page where this data comes from, or you can just Google Coca-Cola Morningstar and you can get to this page as well. I'm looking at the key ratios, and what I'm really interested in are the dividends. And then we can download this data into an Excel spreadsheet. We can analyze the Coca-Cola stock. So first of all, I've highlighted in yellow the dividends for Coca-Cola from 2006. The 12 means it's just an end of the year. So from 2006 to 2015, we can look at the dividends. And going from 2006 to 2007, we see what, about 6 cents increase. From 2007 to 2008, it's about 8 cents. About a 6 cents from 2008 to 2009, to 9 to 10, that's about 6 cents. 10 to 11, that's 6 cents. 8 cents from 11 to 12. 10 cents from 12 to 13. From 13 to 14, about 10 cents. From 14 to 15, about 10 cents. And this is kind of a typical pattern. Companies will increase their dividends slowly, making sure that they have the earnings power to be able to pay those dividends without any risk. They don't have to worry about cutting the dividends later on. So they kind of slowly raise dividends over time. So this appears to be a constant growth rate stock. In other words, using our constant growth rate formula appears to be reasonable. So looking at the dividend growth over time from 2006 to 2015, to calculate the growth of dividends, that's 1, 2, 3, 4, 5, 6, 7, 8, 9 years. So to calculate that growth rate in dividends over 9 years, you can see here from the formula right here, simply taking the rate in 2015 divided by, taking the dividends that were paid in 2015 divided by the dividends that were paid in 2006, and subtracting 1 from that, that's the percentage change. I could have also did, we could have also calculated that as $1.32 minus 62 divided by 62, and we would have came up with 112%. So we've had 112% growth rate in dividends over 9 years. If we want to calculate the annual growth rate in dividends, we want to take the geometric average. So we'll take the $1.32 dividend in 2015 divided by the 62-cent dividend in 2006, raise that to the 1/9 power, so we're using our time value of money concept, and we subtract 1, and our annual growth rate in dividends is 8.76%. We could have also, in the financial calculator, if you prefer to do it that way, we could put in a present value is equal to 60 cents, future value is equal to $1.32, and the number of years is equal to 9, and then compute the interest rate, and we would have come up with 8.76%. So if you like using that time value of money row on the calculator that you've been using for your homework, that's fine. So our annual growth rate in dividends is 8.76%, so we can apply that Gordon constant growth rate formula to value the Coca-Cola stock. So first thing we need to have is a required rate of return for Coca-Cola stock. And the required return has to be larger than the dividend growth rate of 8.76% that we just calculated on the previous page. So my field, I'm going to put in just 12%. And we can examine that, how reasonable that assumption is here in just a little bit. And the last dividend was $1.32, and I got that because in 2015 that last dividend was $1.32. And then just putting in, if you look here, this is simply the Gordon constant growth rate formula. Come up with a value of this stock to us of 44.29. So if we have a constant growth rate stock, and as an investor, I believe I need to get a 12% rate of return. In other words, that's the rate of return that I require for taking on the riskiness of Coca-Cola stock. I would come up with a valuation for Coca-Cola stock of $44.29. Now, I can then go to look at what is today's price of Coca-Cola stock. So when I made this video, back in March, the value of the Coca-Cola stock in the market was $41.62. So we want to buy or sell Coca-Cola. We'd want to buy because we think the asset stock's worth $44. It's currently traded for $41, so we would buy it for $41 in the hopes that eventually the rest of the market will realize that it's worth $44. It's also instructive to take a look at how different growth rates affect the value of a stock. So this is our same valuation model that we had before. And the only thing that's different is I want to calculate the value of the stock for different growth rates. So growth rate in dividends can be negative, it can be positive, it can be 0. Our only restriction is the growth rate in dividends cannot be greater than the required rate of return on the stock. So let's take a look here. We've got, if we have a negative 5% growth rate, you may ask, what company has a negative growth rate? Think, for example, a company that has a established product and it's not coming out with any new product. Maybe it's a mature industry, and slowly over time there's less and less demand for that particular product. Or you could have a mineral extraction, kind of think of a mining operation where over time the profitability of the firm is less and less as the mine plays out and the dividends get smaller and smaller, but it's still generating a series of dividends, so there's still value there. But the value, for example, for Coca-Cola stock, if their dividends were growing at a negative 5%, would only be $7.38. Now, if Coca-Cola had 0 growth rate in dividends, Coca-Cola stock would be worth $11 at a 12% required rate of return. Now, 0 growth rate stock, that's a preferred stock or a perpetuity, because in a preferred stock we do not have a growth rate in dividends because that preferred stock dividend is the same every year. And then we can see that as the growth rate in dividends increases, we see an increase in the value of Coca-Cola stock, and I'll just stop at 11%. And let's take a look at what that looks like graphically. So as the constant growth rate of dividends increases, Coca-Cola's valuation, its stock price, increases, and it's not a linear relationship. So Coca-Cola is right around here at around 8%. If they could increase their growth rate from around 8% or 9% up to 10 or 11%, they could see very large increases in the value of the company's stock. We can also take a look, again using our same Coca-Cola example, where at a 12% required rate of return and a 8.7% and an 8.76% growth rate in dividends, that the value of the stock was $44. compared to an actual stock price of 41, it would be a good buy. Let's take a look at how required rates of return. So if we had a 12% required rate of return for Coca-Cola, as we saw before, the stock price is $44.29. If somehow investors viewed Coca-Cola as less risky and only had a required rate of return, the stock price goes up from $44 to $64. So even small changes in our required rate of return can have huge impact on the stock price. And if we go from 12% to 13%, down to 17%, and so forth, we see that as we increase our required rate of return, the price of Coca-Cola stock goes down. Again, our basic valuation model says that what? The value of Coca-Cola stock is the present value of those future cash flows discounted at a particular required rate of return. So as the required rate of return goes up, the value of Coca-Cola goes down. In other words, the present value of those cash flows goes down. Let's take a look at what that looks like on a chart, and we can see that we're at 12%, we're right around here. And if we have a required rate of return of only 11%, we can see how that stock price goes up. Again, we have this non-linear relationship. This is why even small changes in cost of financing can have a large impact on the value of a company's stock, or small changes in investor perceptions about the riskiness of that stock can have huge changes in the stock price, which helps to explain a lot of the volatility we see in the stock market. When we look at individual stocks, we see every day, wow, the price is moving around quite a bit. But what's happening is it only takes small changes in perceptions about risk to have huge impact on stock prices.